Did you know that right now, thousands of seniors across America are leaving thousands of dollars on the table, simply because nobody told them the IRS changed the rules? If you are 65 or older, or if you have family members who came to this country chasing a better life, what I am about to share with you in the next few minutes could genuinely change your financial situation this year. Stay with me, because this is not something you want to miss. And before we dive in, if you find this helpful, please give this video a thumbs up, hit that subscribe button so you never miss an update like this, and drop a comment below telling me your state. I read every single one. So let's start at the very beginning, because I want you to fully understand just how significant these changes really are. Every few years, the tax code shifts in ways that most people never hear about until it is too late to take advantage. And right now, heading into 2026, we are sitting in the middle of one of the biggest overhauls in recent memory, one that has been quietly moving through Washington under a piece of legislation called the One Big Beautiful Bill Act, or what insiders are calling the OBBBA. Now, I know that name sounds like something out of a fairy tale, but the benefits it carries for seniors are very, very real. Let me paint you a picture. Imagine you are Margaret, a 68-year-old retired schoolteacher living in Ohio. She spent 32 years in the classroom, raised 2 kids on a modest salary, and now lives on a combination of Social Security and a small pension. Every tax season, Margaret sits down at her kitchen table with a cup of coffee, a stack of papers, and a deep sense of dread. She has always believed that taxes are something that happens to her, not something she can control. What if I told you that under the new rules for 2026, Margaret could qualify for a brand new $6,000 bonus senior deduction that she never even knew existed? That is not a typo. $6,000. And she may never have found out about it if someone had not taken the time to explain it to her. Here is how it works. Under the new law, if you are 65 years of age or older and your adjusted gross income, that is your total income after certain deductions, is $75,000 or less as a single filer, or $150,000 or less if you are married and filing jointly, then you may qualify for this temporary deduction. It is available for tax years 2025 through 2028, which means there is still a window of time to take full advantage of it. This is not permanent, friends. Like all good things in tax law, it has an expiration date, which is exactly why I want you to act on this information now rather than later. But that is not the only good news for seniors. The standard deduction, that baseline amount you can subtract from your income before taxes are calculated, has also gone up significantly for 2026. If you are married and filing jointly, that number has risen to $32,200. If you are a single filer, it sits at $16,100. Now, some of you might remember a time when these numbers were much, much lower, and you had to itemize every single receipt and donation just to make a dent in your tax bill. Those days are increasingly behind us, and for seniors on fixed incomes, a higher standard deduction can mean hundreds or even thousands of dollars in savings every single year. And there is one more layer on top of that. If you are 65 or older, or if you are blind, you can also claim what is called an extra standard deduction. For single filers, that adds another $2,050 to your deduction. For married couples, each qualifying spouse can add $1,650. Stack all of these together and you begin to see just how substantial the total tax relief can be for someone in Margaret's situation. It adds up faster than you might think. Now, I want to pause here for a moment and speak directly to those of you who also have family members, friends, or neighbors who came to this country as immigrants, or perhaps you yourself came here from another country and have been building your life here for years or even decades. Because what I am about to share is something that has caused a great deal of concern in immigrant communities across the United States, and I believe you deserve to hear it clearly, honestly, and without fear-mongering. There is now a data-sharing agreement between the IRS and Immigration and Customs Enforcement, ICE. What this means practically is that ICE can now access certain IRS records, including names, home addresses, and individual taxpayer identification numbers, which are known as ITINs. These records can be cross-referenced against immigration files. I understand that for many people, this information is deeply unsettling. You may have spent years dutifully filing your taxes, doing the right thing, contributing to this country, and now you are wondering what this means for you and your family. I am not here to create panic. I am here to make sure you have the facts so you can make informed decisions. And one of the most important things I can tell you right now is this: do not stop filing your taxes. Failing to file creates far more problems than it solves. What you should do is speak with a trusted tax professional or immigration attorney who can help you understand your specific situation, your rights, and your options. There is also a brand new financial change that affects immigrant communities in a very direct way: a 1% remittance tax on money sent from the United States to other countries. For every $1,000 you send abroad, whether to support aging parents, help a sibling, or contribute to family expenses back home, there is now a $10 charge. That might not sound like much at first, but for families who regularly send larger amounts, it adds up quickly over the course of a year. If you send $500 a month to support family overseas, that is $60 a year in new taxes. It is important to factor this into your budgeting so it does not catch you off guard. The Treasury Department is also moving to restrict eligibility for certain refundable tax credits for people with particular immigration statuses. This is a developing area of law, and the details are still being worked out, so this is another reason why having a knowledgeable tax professional in your corner is more valuable than ever. Now, let us talk about something practical that both seniors and immigrants need to be aware of: the shift away from paper checks. The IRS is phasing out mailed paper checks for tax refunds. Going forward, the default method for receiving your refund will be direct deposit into a bank account. Paper checks will only be issued in very limited cases where someone truly does not have access to banking. If you have been receiving your refund as a check in the mail, this is the year to set up a direct deposit option, because delays with paper checks are only going to get longer and more frustrating. There are also some very specific steps I want to walk you through, because knowing about these changes is only half the battle. Acting on them is what will actually protect your money and your peace of mind. The first thing I want you to do is verify your identity with the IRS using a tool called ID.me. This is a secure online service that confirms your identity directly with the IRS, and it helps prevent any processing delays on your tax return. It sounds more complicated than it is. There are step-by-step tutorials available, and many libraries and senior centers can help you through the process. If you are a non-resident alien, meaning you live and work in the U.S. but are not a citizen or permanent resident, and you have not updated your tax withholding Form W-4 since 2020, you need to do so as soon as possible. There is a withholding adjustment of $11,800 that could affect your paycheck in 2026 if that form is out of date. That is a significant number, and it is entirely avoidable with a simple form update through your employer. And for seniors who earn interest on fixed deposits or savings accounts, if your income is below the taxable threshold, you should submit what is known as Form 15H to your bank. This tells the bank not to automatically deduct tax from the interest you earn on your deposits. Many seniors do not realize this form exists, and as a result, they quietly lose money every single year to automatic deductions they never needed to pay in the first place. Do not let that be you. You know, it occurs to me that the tax system has a way of feeling like it was designed for someone else, for accountants, for lawyers, for people with offices and briefcases and 3 monitors on their desk. But here is the truth: every single one of these rules was written with real people in mind. People like Margaret in Ohio. People like the families sending money home every month. People like you, sitting here right now, taking the time to get informed. That matters. It genuinely matters. And the fact that you are still watching, still learning, still asking questions, that tells me everything I need to know about the kind of person you are. We have covered a tremendous amount of ground together today, and I want you to leave this video feeling not overwhelmed, but empowered. Because that is exactly what this information should do for you. The deductions are real. The data sharing changes are real. The remittance tax is real. And the steps you can take to protect yourself, those are real too. Coming up in just a moment, I am going to bring everything we have covered together into a clear, simple action plan, so you know exactly what to do first, what to do next, and who to call if you need extra help. You have already done the hardest part, which is showing up and paying attention. Let's finish this together.